Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is March 20th edition of Market Outlook. Don't forget to go to our website and sign up and get the free text and video newsletter free every week delivered to your inbox. All right, so the rally is relentless. Let's take a look at what's driving it, and we'll take a deeper cut at looking at some of the sectors. First of all, let's just take a look at the key things in the S&P. Well, for one, we've entered into this accumulation phase, right? We're now several days above the 200-day moving average. Now, what is interesting is on Friday, we had an inside day. Now, it did go ex-dividend, so that may have thrown this off a bit, but focusing on the most critical elements here, if we go to, this is a daily chart on the S&P. This green line here is the 200-day moving average. This green line here is the 6-month calendar range. Now, one thing you're going to see is that we broke out from that 6-month calendar range just a couple days ago, sold off a little bit, held both the 200 and that 6-month calendar range, which basically comes in right around 202. Now, what's also interesting is since the lows, the 10-day moving average, which is the cyan line, has not been violated. So from a pure price standpoint, this 202 level is a critical support level for the market. If this breaks or a retracement to this test does not hold, you can definitely see a nice size sell-off, at least to the 194.50 to 195 level, which is equivalent to about a 3% drop or so if we do breach or close under that 201.90 to 202 level. So I think those are the salient points regarding the price structure of the S&P. Now, let's take a look at some of the market breadth as well. And in this particular chart right here, you can see that this is the cyan line is the number of stocks above the 10-day moving average. The blue is above the 50, and the green is above the 200. So you can see that the breadth of the market is definitely improving. Now, we did hit overbought levels, and all you were able to muster is 1 to 2 day temporary declines on its relentless move up. So one of the things to note, whenever you're looking at advanced declines and market breadth, when you do get excessive market breadth, and I pointed this out several videos ago, when you do get excessive breadth, very, very overbought, it often means that the market is really in a strong position and that the sell-offs will be muted. And that's sort of where we are right now. What I would look is to see if we can break beneath this midpoint here, which is 250 of the 500 stocks. If indeed that cyan, that 10-day, can break under the 250 level, I think that would be an indication that a more meaningful correction is underway. Let's take a look at what we have on some market internals and some other information directly on our website. You go to www.marketgauge.com and you go under resources and little big view, and you get this updated on a daily basis. Now, one thing you can see is that the NASDAQ still lagging, down 4% for the year, where the S&Ps and the Dow basically flat. So that's an interesting switch. So going back to the internals, you can see we have nice accumulation days here. 5 accumulation days for the Dow, 3 for the S&P, and interesting, of course, the lagging index is still under distribution. So that is interesting to note. That is definitely a bit of a headwind. what had been leading is now lagging. Last year, the S&P, what was definitely basically flat, with Nasdaq up almost 8 or 9% for the year. So the leading index, the Nasdaq 100, certainly lagging this year. Let's take a look at some other interesting things as well. In terms of sectors and the number of sectors positive, as you can see now, year to date, there are a number of sectors positive. And in fact, year to date, the strongest one happens to be utilities, which is interesting in itself because usually that's defensive. So to have the market basically flat with the biggest defensive sector really is an indication of the market sentiment, right? Where many players have been leaving the market. There's been an outflow in mutual funds and ETFs as well, but the overall index actually up. So cash levels are very, very low. Cash levels are very, very high, and that might lend some more strength or underpinnings to the rally. Now, what is also noteworthy is that one of the things we like to see everything in gear is that we're trading above the 200-day moving average, which we are, and we have at least 3 to 4 sectors that have a positive 6-month change, and that is the case. So from a market internal sector rotation concept, market is now in a much better position, assuming it holds that 200-day moving average and that 6-month calendar range, which I pointed out earlier. Let's take a look at some of the other market internals here. So if we're looking at advanced declines and the McClellan oscillator, you can see we got really overbought, started to wane and sell off, and you know what? We only got a very shallow sell-off, which is not uncommon when you get really overbought. So at this point, we really want to see the McClellan oscillator dip below the 0 line. Right now, it's trading about 167 to 170 level, and that's a pretty positive number. And I would say that the market internals here, although running rich and starting to roll over, a bit more of a positive until we get confirmation based on our McClellan, which looks out 2 to 3 weeks to a month or more, trading below the 0 line. And that's on the S&P 500. Let's go to our next chart. This is the NASDAQ looking at a very, very similar scenario. Now, we are trading a bit closer to that midpoint. And again, we didn't get quite as overbought on the composite, but nonetheless, we got that little bit of sell-off, very shallow, and then it resumed its up move. This is definitely closer to a potential sell signal. You want to check on this website here and see if we actually, on this middle one here, the McClellan oscillator, which looks at advances decline over a 39 and 19-day period, drops below the 0 line. That would give us a confirmation that there is a sell-off in the making. Meanwhile, things are still in gear, but running a little bit rich and working its overbought situation by going slightly up to modestly up, depending on which index you're looking at. Okay, new highs, new lows. Actually, looking really good. You can see the absolute number is a real number here, that green line here, and obviously now in strongly bullish territory. So that definitely lends to the more positive case. This is not a weak rally here in the S&P. We're getting lots of stocks here relative to stocks on new lows, and this ratio here, the new high, new low ratio, is looking really good. Now, compare that to the NASDAQ, and you can see we're badly lagging. And in fact, if we turn back down under that 50 level, you might have just pointed to a potential short-term top as well. So we start turning down. This would coincide with a test of that 200-day moving average, which was still closing under. On the other hand, if we start resuming its way up here and breaking out above that 200-day moving average, that would be a surprise to the upside. So yes, we have come off the lows, but you can see on a relative basis, you really want to see it as well above that 50 line, and it's just sitting right there. So it'll be interesting to see how this indeed plays out. Okay, let's take a look at the VIX, and you can see we're starting to get to the bottom of the Bollinger Band. So that's that's a negative here as well. If we start penetrating much below the lower end of the Bollinger Band, that is indicating a bit of frothiness. So let's keep an eye on that. And again, you can always come back to the website and check. But meanwhile, it's getting close here to a pretty extreme reading. So as you can see, you got a pretty mixed bag here on the market internals in general. All right, let's take a look at sentiment. Now, sentiment is the richest it's running since last September and going back, I guess, about 7 or 8 months. So we are running rich, but the momentum is still to the upside. So we really need to hook down. So this is in gear for the moment, but running rich. I would give this one still positive until it turns down and flips down from this overbought reading. Remember, we got oversold down here, oversold again here off of that rally. And interestingly enough, the test, which actually tested the lows and closed on its lowest price in the S&P, was never matched in sentiment. So you can say that there was a divergence there. Now up over here, as we're making new highs, the sentiment's running really positive, actually better, more positive than it was back at a higher level. So again, this is a situation where with positive sentiment, even doing better than the prior highs of sentiment, where the market, and you compare that to the absolute price, you have a situation where sentiment is definitely leading and still strong. However, again, a hook down could definitely occur here. You got to let the market tell you what it's going to do, not anticipate. React to what the market and the charts tell you. In this case, we're still in gear until we roll over, but clearly on the rich side. All right, let's take a look at the next chart. Oh, actually, we looked at this one already. So one last thing I do want to cover, which is the sector charts. So let's take a look at some of the sectors. Now, this is our proprietary, part of our proprietary triple play indicator, where we look at the relative performance of various sectors or even any individual stock against the S&P. So when the ratio is moving up relative to the S&P, that means it's favoring the upper chart. When it's declining, it's favoring the S&P on a relative basis. Clearly, what you can see here in bonds is we are now trending lower. The relative performance of interest rates relative to the S&P definitely waning. So, on the big sell-off this year, there was definitely this flight to all different types of safety, including utilities, which we'll get into a moment. But clearly, the bond S&P relationship is definitely telling you risk on and not really abating in any way that change in sentiment, which occurred really in mid-February in alignment with the test down here in the S&P of the double bottom. Now, a couple of things I want to point out, which is, okay, what's on fire? What's really driving the market? What's interesting? Let's take a look at semiconductors. Now, semis are definitely a more indicative of the speculative market, and this is why this is somewhat, interestingly enough, this is a positive. I'm going to show you a couple sectors that usually don't do as well during a big market run and are doing relatively well. But look, semis, which got hit mid part of last year or later part, let's say late fall, early winter, got hit really hard, was a clear indication that speculative assets were going to be in trouble. And look at this now. We're back to where we were trading at levels, seen in last April as well. So you can see here that overall the semis, when the market bottom became and now is accelerating to the upside with leadership. This is in deep contrast to IBB, right? Look at IBB, not even picking its head up at all. The momentum to the downside on a relative basis continues. Now, it's pretty strung out. This is now approaching levels from 2014 when the big rally occurred in IBB. So we're back to below that level. So we're running pretty negative here, but that is the drag on the market. Interestingly enough, take a look at metals and metal mining. Explosive to the upside. Now we're above levels of last July and early summer. So that's quite a big difference from the overall market. And look at this, it's accelerating to the upside. Now what's interesting, if you look at this ratio on a relative basis, it can go a lot higher. I mean, metals and metal mining just got crushed. So with commodity prices moving up, some of these companies that were in dire shape are now probably going to be able to at least pay the bills, or certainly their interest payments on debt, which is a big plus, and that can have a compound effect for XME. And again, accelerating to the upside, making up for it really getting crushed. This is definitely interesting factor in the market. Now, the last two things I want to cover is just utilities. So as you can see, utilities started to move up. This ratio here started to move up in the winter of 2015. And that was an early warning that this stock market at least was in trouble for a pretty nasty sell-off. Now, what's interesting is it's kept pace with this S&P rally. Hasn't really exceeded for a couple weeks here. It traded under, but overall on an absolute basis, you can see utilities are actually at its highest level on a relative basis to the S&P for years, for several years here. So what is that telling you? That people are still nervous about the market? If this holds up, this ratio holds up, that is probably going to mean that there could be just still muted upside to the overall market. The key level here is to watch this red line here. If we trade under it, it could tell you that certainly the flight to safety is abating for sure. So you got to give the market a little bit more room here. Again, you can always come back to the website and see what's going on. But this here, on a relative basis, if that actual ratio drops under the 0.23 level, you want to know it and know that maybe even a stronger rally is underway. So that sort of wraps up overall. You can see you got a pretty interesting mixed bag. You got sentiment running a little bit rich, but no reason why it can't continue until it actually rolls over. You have to be in favor of what's going on at the moment. On the other hand, we definitely have some of the market internals telling you its market is well overbought. And in fact, the leading index last year is now lagging, which is also a warning as well. Hope this helps. Bye for now. See you next week, and stay frosty.